increasing at a 40% rate relative to pre-pandemic levels. So the idea that growth is going to dramatically decelerate from here over the next couple of quarters, I think is questionable. And I think that 3 rate cut rather than 6, therefore makes a little more sense. And I think Goolsby's probably right. Of course, he's a voter and we're not. We're just observers.
We are just passers-by and commentators, and they all eventually fade. It's interesting that you talk about the tightening in credit spreads, the dissipation in the equity market, and the sort of the jolt in the bond market. And let's talk about credit. There's a lovely line in our stories this morning. The credit is the easier choice because of the economic momentum. Are you a buyer of credit relative to sovereign and equity?
So from an asset allocation and risk management perspective, we still believe that owning that sort of core treasury and U.S. mortgage-backed security component of the fixed income market is critical in the context of also being sort of long-term equity owners. Because if the economy were to trend lower, we believe equities would come under pressure due to earnings and multiple compression.
Right.
And I think treasuries and mortgages would probably outperform investment-grade credit and certainly outperform high-yield credit in that environment. And of course, we're very cognizant of the reality that credit spreads are historically at tight levels. But we do own investment grade. It's just in the context of that risk management that we really believe in the correlation of assets when the going gets tough in the economy.
It's not shaping up well for the old bond boys and girls, though, is it? I mean, Bloomberg Global Bond Index down 3.5% year to date. It's looking a little bit uncomfortable. I know that 1 month and 10 days data, 14 days data does not make a trend. Is there a level of discomfort at all, do you think, in this market? I mean, they're not exactly short these bonds, are they?
Well, what's interesting is, we're almost seeing a mirror image of what we saw last year, which is to say that long duration fixed income for most of the year, or even the belly of the curve, didn't perform well. It had a bit of a rally, of course, from October into year end last year, rather significant rally, and that sort of saved the year in some sense for the bond market. But short-dated, treasury bills, also, short-dated high-yield credit, it's up on the year. And that's because the economy's strong and the Fed hasn't moved rates. And so that was sort of the narrative for 3 quarters in 2023. It's also the narrative for the equity market, man.
Yeah.
We've seen, equities being driven year to date higher by these, very mega cap stocks where, the small cap Russell 2000 and frankly, the equal weighted S&P 500 is still in flat to negative territory, whereas the S&P is up by 4%. And so that was a trend that we saw last year. And that's a trend we're continuing to see this year. We'll have to see how that plays out.
What do you think of the growth scenario? Because you're a bit skeptical. You talk about restocking, inventory restocking as being one of the bulwarks, the pillars, whatever way you want to present that. Is that just healthy skepticism at the start of the year, given that everything's priced to perfection? Briefly.
Yeah, so everything does seem to be priced to perfection. We're trading at 21 times forward estimates on the S&P 500. And, you look at 2023, we came to the year, economists said 75% of economists on your Bloomberg terminal said we're not going to have a recession. So I think we need to be a little cautious. Any modest adjustment downward in the economic narrative can fundamentally, sort of alter things. And yes, I mean, the GDP data that we saw did indicate that there was some inventory restocking going on, and that could be the tale of 2 stories. If there's demand there for that restocking in the future, that's great. But if those things sit in inventory and are in that demand side is not there to the extent that those buyers thought that we would see, then that could be problematic for the economy. So we think the risk is still that we do have an economic slowdown. It may be a modest one in the back half of the year, perhaps 3rd or 4th quarter.
All right, Aaron, let's see how it plays out. There's still massive tail risks out there between war, between the price of oil, the resurgence of inflation. I mean, there are a myriad of left and right tail risks that can come to the belly. Let's hope some of them don't. Aaron Kennan there with his very latest thoughts on the markets coming up. The Democrats picking up a seat in the House.
Send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Swazi's win narrowing the GOP's already raised a thin majority. The conversation next with Amory Hordan.
So this whole campaign, a whole campaign, has been about how do we communicate to people that we can be better if we work together to try and solve the problems we face in our country. And that's the message. That's the message that resonated with the people in this campaign. Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Powerful message there from the Democratic representative of New York, Tom Suozzi, delivering a victory speech following his special election win. But the Democrats taking back a seat from the GOP following the ousting of George Santos, narrowing the Republicans' majority in the House to 219 to 213. Now, the election occurred on the same day that the House voted to impeach the Homeland Security Secretary, Mayorkas, over his handling of the situation at the border. Anne-Marie Hordern is our intrepid political reporter and anchor of surveillance. She joins me now. So, can I extrapolate this early in February a win for the Dems over the Republicans, or was it idiosyncratic to New York?
So there's two things you need to look at. One issue that I think is going to be a read across throughout the entire nation is going to be immigration. If that's weighing on issues in Long Island, which is a far cry from the southern border, this is obviously going to be weighing on not just those individuals that live in states that border
it's just going to go much further up the up the roster there, isn't it?
It's hitting blue Democratic states. That's for one thing. But Tom Suozzi, what he was able to do was say, even though I'm a Democrat, he was able to put distance between him and the White House, saying the president should be shutting down the border. I agree with him on that. And he also talked about in Congress on how he bucked some of the trends of the Democratic Party when it came to immigration. So he didn't shy away from it, even though our polling shows 6 in 10 voters in swing states lay the blame for immigration at the president's hands. So there is a blueprint, if you will, for some Democrats and potentially some tough districts to run on immigration and not have to deal with all the blowback the Republicans are putting on the president.
Well, maybe this is where the amplification, I mean, who am I to talk about political strategy? I've never run for office, but I mean, it's a big understand yet. Mind you, can't run in this country, can I? President of Ireland is always up there.
You can't be president, sorry, Matt.
No, I know, not yet. Never. But we've got an impeachment. I mean, American politics is fascinating. We have an impeachment, of course, against Mayorkas. Talk me through that, and what is that signal?
Well, it's the second time they tried to impeach him. They didn't have the votes the first round, and which is why Tom Suozzi picking up New York 3 is so interesting, because if he was sworn in and was on the floor for that vote, the impeachment would have never went through. It went through on the slimmest majority absolutely possible on a second time around. You have to think of Speaker Johnson waking up this morning looking at his dwindling numbers of this majority he has. To get that impeachment through, Steve Scalise had to come back. He's getting treated for cancer, for blood cancer, had to come back to Congress to cast his vote to get that partisan impeachment bill through. That is what you're dealing with right now in the United States Congress. Very slim majority, and even slimmer this morning waking up in the House of Representatives for the Republicans.
Okay, well, it just shows you just how tenuous it is. Anne-Marie, thank you very much. Anne-Marie Hordern there on the politics in Capitol Hill and New York. Long Island. Haven't been yet. There's a journey. Now, for some, the sector price action this morning. Abigail Doolittle has that for me. Abby, what have you got?
Well, quite a contrast to yesterday's sell-off. Today we have the S&P 500 up about 0.5%. Broad sector participation, industrials, all the way down to consumer discretionary, up somewhere between barely at all, up to about 0.9%. The one stock or one sector that is not higher, staples. As for a sector that's been soaring in recent days, the S&P Transportation Index up about 5%. And this has to do with Uber, because Uber right now up 9%. Its best day since May. Lyft up more than 30%. Its best day ever, not included in this index. But of course, Uber announced that buyback, really giving that transportation index a boost.
Yeah, a nice kicker there. Abigail, thank you very much. Abigail Doolittle with the sectors for you. I'll take you through what you need to watch for the rest of the day into tomorrow. It's a beautiful day in New York. The markets are in the green. What's not to love? 49.80. trading diary for you for the rest of the week. The Fed Vice Chair for Supervision, Michael Barr, speaks at 4 p.m. Eastern. Fed speak continues, Waller and Bostic into Thursday. Will they reinforce the Goolsbee narrative? Plus, we'll get retail sales and another round of jobless claims. Finally, Friday, San Francisco Fed President Mary Daly, and we get the PPI numbers. That was Countdown to the Open.
We're 30 minutes into the U.S. trading day, and it's Wednesday, February 14th, and here are the top stories we're following. Stocks look for direction. The S&P heading higher after a two-day slide, and we're more than halfway through earnings. We'll get you the latest on Airbnb, Lyft, and all the drama around those releases. And it's Valentine's Day. We'll speak to a co-founder of Major Food Group. That's the company behind Carbone, Seydel's, and the exclusive ZZ's Members Club. I'm Shonali Bassick in New York. Welcome to Bloomberg Markets. We are looking at an S&P looking to bounce back after a slide. Investors being caught off foot from inflation data just on Tuesday, and on Wednesday now we have about a 0.5% gain in the S&P 500, and same goes for the Nasdaq 100. You have to remember that Russell 2000 now rising more than about 1.4% on the day. And remember, this was an index yesterday that had its worst day since the summer of 2022. The two-year yield we're watching watching as well, because we're watching some cooling, a little bit in the bond market here, because the 5 basis point drop you're seeing comes off of an 18 basis point surge just yesterday. So we are still hanging out above 460 on that 2-year yield. Now back to stocks, it's a tale of two ride-hailers in the market today. Lyft is explaining to investors how a clerical error overshadowed a strong earnings report. And Uber announces its first ever share buyback plan. For more, we're joined by Bloomberg's Ed Ludlow. Ed, how do these two rivals set up for today?
Yeah, I think what's so interesting here is, did the clerical error overshadow earnings? I mean, this is wild. Lyft being up 35% on what was, it was a strong quarter. And the market's kind of seizing on this idea that if you look at the gross bookings outlook for the first quarter, even at the low end of that range, Lyft is saying that they will exceed gross bookings expectations in the quarter ending in March. The thing about Lyft, though, is it just doesn't have the diversified business that Uber does. It does mobility, but even within that, it doesn't even have the same kind of tiers of premium products. So if you take an Uber, you can go Black or Lux. I think that's what you take to work. Or if you're kind of the everyday person, me with UberX. But what the data point the street is seizing on is the take rate, the amount of money that Lyft takes from each transaction going up, because they've done really good work operationally. So that is kind of, I think, what's happening in the moment. But yeah, last night was wild.
How do you know I don't bike to work, Ed? Well,
Good point.
Speaking of these ride-hailing apps, how are they all faring in this particular market? You know, on one hand, this buyback plan from Uber, what does this mean to investors moving forward?
Well, Uber's coming off the back of its first full year of profit. I was writing about this at the beginning of the week in the Tech Daily because it's a really interesting case study for what's happening in the economy, the gig economy. You know, what we see from Lyft's earnings, in spite of the clerical error, which we can break down, is that ridership growth appears to be intact. Same with Uber. Uber showed that their algorithm is much more successfully matching the demand that's there with the availability of supply. And at the same time, Uber told us that the driver supply is up 35%. There are some worries in that, right? We know about all the layoffs in the technology industry, the impact of higher rates on all kinds of households. So are those new drivers going to that platform because they've lost their job? We know that participation in the economy is an interesting point. But overall, it looks good for those sort of convenience ride-hail delivery apps right now.
You know, the converse to this story is Airbnb down more than 4% on the day today as well. You know, do the sharing economy companies all benefit equally in this kind of environment, or do you see some pain?
Well, in Airbnb, it's the classic case of lapping tough comps because they had an astonishing quarter a year ago at the start of 2023. And what's interesting is the guidance they gave for revenue at the low end, $2.03 billion. Even that low end of the range was numerically above street estimates. But it's the narrative that Brian Chesky's saying that, look, we're just not going to grow at the same click in this quarter, partly because of lapping those tough comps, but the environment is very different. And at the same time, Brian Chesky's telling investors, you know Airbnb is a platform to rent a house, essentially, but we think in the future it's going to be something quite different. But then he didn't go the whole 9 yards of telling us. So that's going to be an interesting story going forward.
Ed Ludlow, we thank you for your time, and be sure to keep an eye on Bloomberg. Lyft CEO David Risher joins us at 11 a.m. Eastern this morning. Now, for more on the markets, we're joined by Binky Chadha, Chief Global Strategist and Head of Asset Allocation at Deutsche Bank. Binky, this week has just been chock full of consumer data, both on the economic side and on the earnings side. We are seeing a lot of divergence in how consumers across America behave. What are you most concerned about as we head deeper into earnings season?
What I would say is that, earnings have basically done very well through 2023. And the last quarter is perhaps, modestly disappointing is the way that I would put it. So equity market tends to focus on year-on-year moves in earnings for a variety of very good reasons. We try to look also at quarterly earnings, and you need to do seasonal adjustment for that. And what I would say is that the first 3 quarters saw very, very strong sequential growth in the first 3 quarters of last year. Earnings are up about 11.5%. We come to the fourth quarter. that's when the year-on-year picks up in a big way, and year-on-year S&P 500 earnings, running close to basically 10%. You take out energy and you're closer to 15%. So that all looks very good. But if you take a look sequentially, the fourth quarter is, flat to slightly down. So that's a bit disappointing. I would add that Q4s tend to be pretty noisy, so the signal to noise ratio is pretty low. And if you look at the bottom up consensus and what it's done in response to the earnings that we got for the fourth quarter, it really hasn't really done very much. So the company analysts are not taking away too much, even though to us it's a slightly disappointing quarter. But I think of it really as a bump in the road to recovery, basically.
Vinky, the other problem here is as we're looking at all of these earnings reports, trying to get a read on how companies are faring alongside a consumer that has borrowed a lot of money recently. One big problem is that the January inflation print came out well after that. And how do investors now look at this complicated inflation story and how it will impact corporate America over the next 6 to 12 months?
Yeah, so yesterday's inflation data, I mean, I think, as everybody knows, owner's equivalent rent played a big role in that. We've looked at inflation coming down as not only reducing basically the risk from the Fed having to tighten too much and create basically a slowdown or a recession, but the decline in inflation as actually having been, a big positive driver of growth. So, the first thing to note yesterday is yesterday's higher than expected inflation print, bad for that dynamic. I would argue, if a lot of it's coming from owner's equivalent rent, the good news is that, it's an imputed price that nobody pays. It's in the index so that we have an idea of broader sort of price trends, and that's, to do with the price of houses really, but no one pays them. So it doesn't really hurt that dynamic just yet. And I think, by now it's so well understood that there's sort of disconnect between the rent and the owner's equivalent. That is, it's an unusually wide disconnect on a month-on-month basis. So, that just increases the noise. But we're very much in the camp that disinflation has been happening for a while, and the trend continues, and not really too concerned about that just yet.
Well, let's talk about interest rates in relation to inflation data here, because you are seeing expectations for the market change very drastically on what investors believe will materialize in terms of rate cuts. You see the 2-year yield hanging out by 460 now. How does that impact valuations in the stock market?
Yeah, so we are in probably what I would describe as a rather minority camp. We don't think that interest rates directly have an impact on equity valuations. Sort of a longer, deeper discussion for which we would need sort of more time. I think, the key basically over the last couple of years has been really interest rate volatility rather than the level of interest rates. So, too much movement up, too much movement down is going to create volatility, and that's going to impact basically equities. But most volatility is temporary and does pass. It can be sticky, as it was back in 2022. But I think that rates are probably still a touch low. If you think about the fact that over the last 6 quarters, we've had 3% GDP growth. So over the last couple of quarters, it's even higher than that. So, where should rates be? I would argue probably a little higher than they are right now.
Vinky, with the market that you're drawing out really quickly here, what is your favorite sector to be looking into buying into at this point, given how far valuations have come?
Sure. What I would argue is that basically the biggest theme, which still has to play out completely, is the market very much focused on an economic slowdown and a recession. That's clearly gone at the market level, but there are pockets in there. Some of what you basically mentioned, which is the cyclical parts of the consumer and the banks, I would argue, are still pricing in a lot, and that's basically where we belong.
Vinky Chadha of Deutsche Bank, thank you for your time. Now we're going to take a look at what's moving in markets right now with Bloomberg's Denitsa Seikova. Denitsa, what are you looking at?
Yeah, let's go back to Airbnb. They had a very strong 2023, but that caution on what's coming next is driving the stocks down 4%. We actually saw an initial positive reaction when the earnings came out. Like, if you look at that revenue number, it's up 17% to 2.22 billion. So that's a very solid number, and obviously, like, most of the numbers look better than what analysts were estimating. Of course, it's important to say that Airbnb had a stellar year last year, and some of the bookings and experiences are expecting a normalization of demand this year. So therefore, this reaction. We're seeing similar cautiousness from Expedia. So generally, you'd say it's a bigger theme in the travel industry. That said, CEO Brian Chesky is trying to bring positive news to the investors. He's talking about artificial intelligence. He's talking about third-party services. So we're yet to see if this can actually offset some of that cooling.
Another area where the consumer really hits the road here is Kraft Heinz. How are investors reacting to their print?
For sure, yes, we're seeing some consumer pressure building up. We're seeing a SNAP benefits reduction. We're seeing those consumer pressures building up. And the stock actually declined 6.5%, which is like one of the biggest declines in 5 months. And it missed on sales. Overall profits weren't bad. But what we saw from that company is that high inflation and bottlenecks in supply meant that that company reduced its range and the products it was offering. We're expecting now with margins likely to recover as that cost inflation is easing and supply chain issues are easing as well.
More inflation issues, Heineken as well.
Of course, this is another company. I feel it's like a bigger theme we're seeing. Inflation is putting pressure on beer demand next year. Heineken saw 4.7 year-on-year drop in its volumes. Of course, we have seen that company raise prices as volumes have been falling. So what we're seeing is actually consumers are balking at those price increases, and this is a wider industry theme. We saw similar results from Carlsberg and similar reaction from consumers. So we're yet to see if the consumer can keep with those price increases.
Denitsa Seikova, we thank you for your time and keeping such a close eye on the markets. Now coming up, we're going to talk to Canadian gold miner Barrick Gold. They had beat fourth quarter estimates. We're going to speak to the company's CEO, Mark Bristow, next. Stick with us. This is Bloomberg. gold on a decline after a rally that hit levels we haven't seen since the pandemic. That rally is now fading as the prospects of rapid rate cuts by the Fed become much more unlikely. And for more, we are joined by Mark Bristow, Barrick Gold President and CEO. The company reported an earnings beat earlier today and announced a buyback for investors as well, a new buyback program. Mark, thank you for joining us. A big question in the market surrounding gold is where prices go from here. How much can they come off the highs we've seen in December? How do you really talk to investors about the price itself?
So it's a very interesting time, and I've been talking about this for a while. Everyone wishes the interest rates are going to come down rapidly, and of course, the bet on the gold comes back on. But I think there's a much more systemic problem, and that is the global economy is not in good shape, and neither is the U.S. economy, and so I think we're going to see interest rates higher for longer, and we'll run the risk of stagflation, and ultimately that'll bring back the upward pressure on gold, because it's then risk on as far as the global economy goes, and of course the U.S. economy. So I think this is a dynamic that's going to play itself out. At the end of the day, I still believe that the risk is on the upside when we talk about the medium and long term for gold price. And that's what we allocate capital for the long term. Today's gold price or tomorrow's is actually not relevant in our business.
Well, that's interesting. Do you think that'll actually hit new records at that rate?
Yeah, I think there's very real risk on the upside, and I think. But again, I've never been one who runs a company for a specific gold price. We've focused very much on making sure we can make returns for all our stakeholders throughout the cycle.
One big question when it comes to Barrick Gold is not only about the industry you're well known for, the gold industry, but how you diversify. Mark, at what point will you consider more mergers and acquisitions to get there, particularly in the world of copper?
So, we are the only mining company with real organic growth in the short term in copper. We set out to expand our portfolio from a very gold-focused portfolio to one that includes copper. And of course, our very big project, the Reko Diq project in Pakistan, comes with both. It's in its own right a world-class gold mine and equally a world-class copper mine. And so that's the ideal model for us going forward. These big porphyry deposits, we call them, that yields both high amounts of gold and copper. And again, I've repeatedly said that M&A is definitely a tool that you can use to grow, given that you can create that opportunity to be able to deliver value other than just relying on the commodity price to lift you above the price you pay. We've been able to do that consistently throughout the last 5 years in Barrick, and I've certainly done it for my entire career. And so we're hesitant to be able to, or we're hesitant to pay premiums that are difficult to give returns.
Well, that was my
M&A.
next question. Is our gold valuation still too prohibitive to make a significant acquisition?
I think it's very important to, what we've seen across the mining industry recently is that the commodities have softened, the commodity prices, and also the equity prices have also softened. So it's a challenging time to be able to do M&A, and it's always about relativity. Is there a relative opportunity between the target share price and the share price of the acquirer? And so that it's a complicated equation. We've, as I said, managed to get it right most of the time, and we're very diligent in how we assess M&A opportunities.
How do you view the geopolitical tensions that have been brewing around the world? Do you think about this as a boon for gold prices, more movement into gold as a hard asset, or do you think that there will be more challenges moving forward in terms of really tapping mines for gold moving forward?
So really, we've seen that. It's one of the real supporters of the bottom end of the gold price is the risk profile across the global economy. And in particular, we've seen a big move to de-dollarization, which of particularly emerging market central bank asset profiles. And on the same time, the deglobalization of this world, which is a tragedy really, but that's driving inflation, making it much more complicated as far as assessing risk and on a global basis. We are a global business. We operate in all four continents across the globe, so we manage that and operate in that dynamic all the time. But without a doubt, there's been a big shift. The biggest purchases of gold recently have been the central banks, emerging market central banks, as they move to rebalance their asset portfolio in the face of reducing their exposure to the US dollar.
Mark Bristow, Barrick President and CEO, thank you for your time. Now still ahead, we'll take a look at companies making the most buzz on social media today. Social climbers, that's up next. This is Bloomberg. Time now for Social Climbers, a look at the stocks making waves on social media this morning. First up, Robinhood reporting fourth quarter revenues that beat estimates. The stock hitting its intraday level high, the most since April 2022. Executives at the online brokerage said the deposit growth has been outpacing levels seen in 2023. Next, MGM not having the same kind of day. It's eyeing some acquisitions in online gambling, and it's reporting an increase in fourth quarter revenue, but it's also showing some weaknesses in its regional national businesses. Finally, Instacart falling short of earnings expectations. The online grocery delivery company is also cutting 250 jobs as part of restructuring that will emphasize advertising and e-commerce technology. You can follow all the latest company buzz on TRNG Go on your Bloomberg terminal. Now coming up, we're going to talk about consumers. They are battling higher costs as couples venture out for Valentine's Day. We're going to discuss it with Jeff Zelaznik. He's the Major Food Group's co-owner. That's up next. Stick with us. This is Bloomberg.
Great questions.
I'm going to bring you in here with the check on the market. We have the S&P 500 back in the green. We are looking to hit the highs of the day. We are rising a little bit higher. We're looking at an S&P 500 down up more 0.7% now. We are gaining a little steam here. The NASDAQ 100 gaining even more steam, close to 1% higher on the day. The Dow Jones Industrial Average up about 0.3% on the day so far. Remember, this is after the market got caught flat-footed yesterday after inflation data that was worse than expected, rising more than expected. We're going to talk a lot more about that inflation story and how it's impacting different stocks throughout these indices. We'll be back in a minute. This is Bloomberg. A little bit of green on the screen. We're going to get a check on these markets with Abigail Doolittle.
So we do indeed today, Sonali, have a little bit of a rebound rally. You can't see it here because this is a 3-day chart, but here is the gain for the S&P 500. Right now, up about 0.7%. Volume is anemic, 20% below the 20-day average. And on the week, you can see stocks are lower after yesterday's sell-off. But stocks yesterday closing well off the down 2% lows, closing down about 0.3%. This, of course, on that hot CPI report. Now, if we take a look at some of the other indexes and asset classes, the NASDAQ 100 over the last 2 weeks really getting a nice bid, up about 3.6%. The VIX flat. Yesterday, at one point, we had the VIX at a 17 handle. Now it's back at a 14 handle. Crude oil, a little bit of a bid there, up 2.5%. And then the 10-year yield, this is the real story on this board. Take a look at that, up 37 basis points. So traders knowing into that CPI report, some of that information somehow getting out there early, because yesterday the 10-year yield up, I think, about 10 or 15 basis points, today down a little bit. So yesterday's move on yields, that surge higher, wasn't just all about yesterday's CPI. We've been working toward that, and the idea that the Fed might not be cutting as quickly and as soon as expected. As for the S&P 500, we've been looking at this chart for weeks, really, talking about the bearish divergence. So as stocks have been climbing out of December and really out of October, but in particular December, you can see this nice rally. But take a look at the RSI, this momentum indicator. We are seeing a set of lower highs, 3 lower highs in a row. That means that the record high made recently, it is made on less bullish momentum than back in December. That is bearish because it tells you that weak hands are currently buying stocks, making the opening perhaps, Sonali, for more action similar to what we saw yesterday.
Bloomberg's Abigail Doolittle, we thank you for your time. Now, higher inflation hurt the market, but will higher inflation be a Cupid killer this Valentine's Day? We're going to ask the mind behind storied restaurant brands like Carbone's, Seydel's, and The Grill. Here now is Jeff Zalaznik, Major Food Group co-owner. You know, it's interesting because there is expected to be a lot of spending for this Valentine's Day. But Jeff, with people still hurting from inflation, are you seeing the same kind of bookings and excitement around eating out, particularly at the higher end here?
You know what, it's crazy. We really are. I mean, I think that we have not seen everything in our kind of luxury portfolio is only going up, and people seem to really be choosing to spend their money and their time with their loved ones and the people they care about, and more specifically, but also celebrating themselves at a level that we have never seen before as one of the largest restaurant groups in the world. I mean, and we keep being surprised, but also thrilled by the way that people are behaving and the way that people are celebrating themselves in our restaurants and other restaurants. And to be honest, I wish that I could say that these things were a problem, but they're not.
Well, I'm curious about the difference here. You do have some options at the very high end here, but you also have other options that are more affordable, like Parm in New York City, for example. Are you seeing a big difference between kind of the luxury consumer that's eating out and the folks that would spend more money every day on eating out?
Yes, I do. I think that the luxury market right now is at an incredible place, and I think that I think that you see more of a difference. We're fortunate that, at Parm, which is a sandwich shop, and at, the rest of our restaurants, which is our entire portfolio of about, over 60 restaurants globally, where you have a much higher price point, closer to $200 a person. The things that we have seen is that those things work. And I think that unfortunately what's happening is that the middle is where things are really getting hurt, because what you have is people saying, I really want to spend money and spend it the right way and do this the right way. And I think that's a combination of not only what's going on with the marketplaces, but also just still a psychological reaction to COVID and everything that happened, and people realizing that there's a time and a place, and that they're going to spend their money and they're going to go out. They want to do it the right way, and they're not going to wait for that special day. But especially on a special day like today, on Valentine's Day, they're gonna enjoy themselves. And then I think that the middle is where there's a lot of issues right now in the restaurant business, and I think that it's a difficult time for that sector because of the marketplace and because of what you're talking about today.
It's interesting, with the luxury brands doing so well, there are a lot of questions on whether you have plans to open another club like Zizzi's somewhere else in the world. I mean, this is a club with a $50,000 membership in New York.
Yeah. We're going to keep opening them. I mean, Zizzi's is, Zizzi's is going to be, is packed last night, tonight, Valentine's Day, not Valentine's Day. Zizzi's has been an incredible success, and we are super excited about it. We're definitely going to bring it to other cities, but right now we're focused on the incredible one we have in New York City. as well as we have one in Miami. And we are definitely looking to expand it. I mean, I think it's been, listen, for what we've done is that we've focused on, we focused on food and beverage and service and not just a place to hang out, which is what most private clubs have become. And, they're a nice place to hang out. The food is an amenity. It's not the focus. And what Major Food Group is about is food and beverage is the focus. We focus on food and beverage. We focus on service. We focus on hospitality. And, of course, there's beautiful places to hang out. Of course, there's beautiful things. We have multiple restaurants. You can call us 2 days ahead of time. You have your own culinary concierge, and you can tell us what you give me your mother's chicken soup recipe, and we'll make it for you in 2 days with the best chefs in the world cooking it for you. So, I mean, we're really focused on being different in terms of the club space, in terms of what food and beverage means in the club space and what the future of the club space means.
What's the most exciting food city in the world right now? If you're looking at opening, and I know you have Carbone in London in the works, what is the most exciting place that you would open a new location right now?
Listen, I think Miami continues to be incredibly exciting. New York is always going to be exciting. We're looking at, we're very focused on London, the Middle East, and I think also some exciting cities are Tokyo, Seoul, and Singapore.
So when you think about not just locations but partnerships here, another interesting thing you did was partner with Marea. What other types of brands are you looking to partner with, and is there anyone you're currently in talks with?
I'm in a lot.
Break some news here, Jeff, for me.
I'm in a lot of talks all the time, but Marea has been an incredible brand to partner with and to bring into the Major Food Group family, and we are incredibly excited about announcing a few new locations for that brand. I literally just got off the phone having that discussion about that. But no, you should expect a lot more of, one thing we're adding to our already incredible lineup is bringing great brands into our family that fit the feel and kind of DNA of Major Food Group, and helping them expand around the world. And I think this will be the first of many, and we can talk about. We'll have lots more to talk about very soon.
It's interesting. You're talking about so much excitement over this higher end consumer, the luxury brands here. Are costs going to rise in that area? The membership alone seems eye-popping for ZZ's, but the reality is that wealth has grown a lot on the higher end of the spectrum. Can you charge more?
Well, I think we try to charge appropriately for what we're serving and for where we are in the market. We're not trying to overcharge. We're not trying to, I think it's no different than any luxury retail company in general. I think that we are pricing things accordingly. I think there's always room there's always going to be room for pricing if, cost of goods and labor goes up. And we'll continue to adjust accordingly, but we don't look to price just to price. We price based on, the services we're providing and what we're serving. And, your main topic of labor and cost of goods, they are definitely rising, and prices are going to continue to go up. And I think that at this moment, that does not affect the high-end luxury field.
Where are prices going up the most for you? Is it still labor? Is it real estate? Or is it the cost of food itself?
Labor is always going to be the biggest, right? Because the competition is it's just labor plus competition for the best people equals cost. And, I think that cost of goods have gone up significantly. But, we've been able to adjust pricing, and I think that customers have understood that, because anyone, people that generally eat in our restaurants, they understand the macroeconomic and microeconomic conditions of what's going on. You know what I mean? And so, we're not just when we raise prices, for example, we don't raise them just for fun. We raise them because our costs went up. And I think that, we're very fortunate to have a customer base that understands that and understands what's going on in the world, and that, you know, if costs go up, and we all have to deal with it together.
Jeff, what about the Ozempic craze? Do you see there being an impact to how people engage with your restaurants with so much of a focus on these obesity drugs?
I think Ozempic and Mounjaro are the greatest things that ever happened to restaurants, because I think that, but we did have to tell our restaurants, you know, there used to be a rule in restaurants where, you know, if the plate didn't come back, you know, fully eaten, you would bring it to a chef, and you would look at it, and you would wonder why, and you maybe talk to the customer. And I think that the only change has been that I've had to now go and say, by the way, when the plate comes back half full, that's not a problem. That means that someone's on, you know, everyone's taking Ozempic and Mounjaro. And I think that I think it's a miracle drug. I think it's an incredible thing. I think that has zero effect on how much people spend. In fact, I think people spend more because they don't want people to necessarily know people to think they're on it. So they end up ordering more, but potentially eating less, which doesn't affect us in terms of you know, whether they eat the whole portion or the half portion. It's the portion. So I think it's a great drug, and I don't think it has any effect on our you know, seeing patrons order. And if anything, people are saying, I didn't say Ozempic is a miracle, but I think Mounjaro is a miracle drug. But I think that at the end of the day, it doesn't affect people's ordering. People order more and they eat less, and they feel better, and they're healthier, and that's a great thing. But it doesn't affect the check. My check average only goes up because maybe they now taste 10 things instead of eating 2 things, and it's totally counterintuitive to what anyone would ever think would happen, but it's actually true.
Right.
And I watch it personally all the time.
Jeff, I hope you have great plans for your own Valentine's Day. Thank you to Jeff Selaznick of the Major Food Group. Now, coming up, we're going to talk to Stephen Meyer. We're going to hear from him from Wall Street Week, the New York City retirement system CIO, about changes in the New York City's pension fund's asset allocation. Stick with us. This is Bloomberg. York City's pensions are boosting allocations to investments like areas in private equity and alternative investing. Wall Street Week host David Weston spoke with Stephen Meyer, the New York City Retirement System CIO, about the changes.
From a private markets perspective, we're increasing our exposure to private assets anywhere between 6.5% and 7% on average across the funds. And that means over the course of time, and we'll go through a pacing plan process for deployment so we get vintage year diversification, where we're looking to increase our exposure to private assets by between $15 and $20 billion. We're about $60 billion now, so that'll take us between $75 and $80 billion once it's fully deployed over time. So we actually think those are real key performance drivers for the funds. We look at those as bringing interesting diversification away from public markets. Again, through our legislation, we had a constrained opportunity set previously. We now have a little bit more flexibility to generate those returns that our portfolios need to pay beneficiaries.
I noticed you say private assets, so it's not just private equity, it's also private credit and other things. How does that break down roughly? Do you have a breakdown within the category?
Sure. So private equity allocations across our funds are anywhere between 10 and 12% with the new allocations. Alternative credit, about 6 to 7%. Infrastructure, about 5 to 7%. Core and non-core real estate hasn't had a significant change. It's up at the margin a little bit. And again, 2 of the 5 pension plans that we manage for the city of New York for police and fire actually invest in hedge funds. So they're about flat there.
Where is the money coming out of that otherwise would have gotten allocated to?
That's a smart question, David. It's coming out of, for the most part, public equities, U.S. and non-U.S. So we've actually, because of the legislation that constrained our opportunity set, we had a slight overweight to equities at anywhere between 43 and 46%. So that's coming down. I'd say in fixed income, given the backup in base rates and the widening of some credit spreads, that's been pretty much maintained, maybe off a little bit, but anywhere between 6 and 7% reductions over the entire $265 billion portfolio in equity exposure over time.
Steve, I'm wondering what effect the increased interest rates have had on your investment decisions. When you say 7% target rate you have, you can get 5% in fixed income these days, right? It was that you couldn't get anything hardly. Now you get 5%. That's getting pretty close to 7. Do you allocate more toward fixed income?
A little bit. We've shifted around a little bit. One of the things that we've done in our portfolios as a result of the strategic asset allocation review is we actually eliminated TIPS. TIPS actually performed below our expectations in 2022 and 2023. They barely outperformed nominals, and they tend to respond more to long-term inflation expectations at 10 years, which really means it doesn't work as a short-term hedge. But in terms of our allocations and our holdings of fixed income securities, yeah, you're absolutely right. The base rates help power the yield, provides a nice balance for the portfolio.
Lastly, Steve, one of the things that we've talked about before is so-called ESG, environmental social governance. And people don't like that term anymore, but whatever you want to call it. It's been controversial. I think you even had some litigation at one point over it. Where are you right now on that question about how you take into account some of those risks, as it were, in investments as you make your investments?
So, David, we've never invested in any products that have the ESG moniker or have a label of ESG. However, every investment we make, we look through an ESG lens, meaning we look for environmental, social, and governance factors in our portfolio companies that will drive long-term value creation and help mitigate risks such as litigation risk, regulatory risk, and reputational risk. And we think that the funds, the companies that we invest in our underlying funds that adhere to ESG standards will have better long-term results and again, be better investments for us, again, over a longer period of time. But we look at everything through an ESG lens, but we do not invest in anything with an ESG moniker. It's not a social program. We're fiduciaries, and we invest solely to generate returns for our pension beneficiaries and participants.
So you take into account, in order to get the return, do you have enough of an historical experience now to know whether, on average, over time, you actually can get better returns by taking into account some of those risks?
Oh, I definitely think so. I think the companies that have more of a long-term perspective, that look at the potential impact of their externalities, that consider the safety and well-being of their workforce, that look at the impact on climate associated with their operations, are going to be better positioned to reduce exposure to reputational damage, litigation, regulatory risk, and can, again, drive long-term value creation over time. So we actually believe we've demonstrated very effectively that again, looking through that lens is very beneficial to the portfolios.
That was Stephen Meyer, New York City's Retirement System CIO, and we're joined now by Wall Street Week host David Weston. It's interesting. There are a lot of money managers on Wall Street that are probably pretty excited to hear that he's boosting allocations to private equity.
Isn't that right? Because right now what we hear is private equity is not the favorite place to go, particularly because they're having problems returning the money right now because of the interest rates and what it did to the valuations. And he's saying, no, I'm really wanting to go more and more into private equity and private credit, some of the private alternatives.
The interesting thing, too, is that he's taking it out of public equities to get there. Yeah. Why exactly?
Yeah, well, he thinks he can get better returns over time. Also, they tend to be less volatile because it's not traded quite so fast. And I asked him about the liquidity issue, and he said, yes, there has been an issue, but he thinks that's being relieved now, and over the long term, it won't be a problem. So he's happy with it.
It's interesting because when I speak to kind of the Apollos of the world, they would rather be seen in that fixed income bucket rather than the alternatives bucket. I mean, is this too little money for too big of a pie of alternatives?
Yeah, exactly. I mean, there are so many alternatives out there. Although he's got $260 billion he's putting out to work. So he can put in a lot of different little buckets, and he's basically decided that's where he wants to go. He's been working on this for some time. So tomorrow, Shonali, we're going to have on Libby Control from PIMCO. We're going to talk to her about the election coming up and what it might mean for policies that involve Wall Street. That's tomorrow on Wall Street Week.
David, thank you so much. Coming up, we're going to talk to David Risher, the Lyft CEO. He's going to be joining Bloomberg Technology with Caroline Hyde and Ed Ludlow up next.
heart of where innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York.
And I'm Ed Ludlow in San Francisco. This is Bloomberg Technology.
Coming up, we sit down with the CEO of Lyft to run through the company's results, break down that all-important clerical error that led to, at one point, a 67% surge in its shares.
Plus, we'll be joined by OpenAI chair and former Salesforce CEO Brett Taylor as he raises $110 million to bring AI agents to business.
And fighting talk from Mark Zuckerberg as he personally reviews Apple's Vision Pro. What are his takeaways? Not good. We'll discuss that and so much more throughout this hour. But first, let's check in on these markets because, well, some reprieve after yesterday. The sell-off, the CPI print. Today we decide we're going to be pushing these stocks a little bit higher once again. Nvidia and some other key companies on the upside. Nasdaq up some 0.3%. I dig into the detail on a number of individual companies that reported. And look, Airbnb still actually managing to post a strong fiscal quarter. But are we seeing some moderation in growth in terms of ultimately how much we're seeing the room rates tick up? That's what Bloomberg Intelligence points out. And also remember, Airbnb's had a bit of a run up in the stock anticipating these numbers. We're down almost 5% on the day. Uber giving money back to the investor base. Remember, they had a really strong quarter. They posted it last week. And then today, after an investor meeting, they're giving us a share buyback. We're driving that stock up almost 12% on the back of that as they manage to be bringing profitability and therefore capital back to the investor base. Let's have a look at what's happening, though, with the rival, Lyft. I mean, what an extraordinary day we had yesterday. Earnings posted, but an extra zero crept into the margin forecast, 500 bips. That was clerical error, they called it. We rose up to 67% in after-hours trading. We then sunk back down. Now we are still trading higher on Lyft, but that 500 margin becomes a 50 bip margin overall. We've got to dig into the growth of this business and actually how they're giving back to the consumer, a key conversation that we're about to have now.
Welcome to our TV and radio audiences worldwide. Joining us now on the company's fourth quarter earnings is Lyft CEO David Risher. And David, a clerical error.
Yeah.
What happened?
Well, look, first of all, it's on me. There are a lot of eyes on this press release, but at the end of the day, my bad. But look, I don't want it to take anything away from the butt-kicking performance that the business did, thanks to all of our employees and thanks to millions of drivers. I mean, look, we had our financially strongest quarter we've ever had, and I'm super excited about it.
To be clear, this was simply a mistake?
Yeah.
Human error.
Human error.
The stock rose as much as 67% in after hours. As Caroline pointed out, it's significantly higher this morning. Yeah. And we can talk about the performance in the quarter gone and the performance in the current period. This may sound bizarre to you, but I think it's a real question. Did you guys use AI to write that press release? Seriously? Or is this as simple as you are calling it a clerical error?
No, it was a clerical error. Yeah, no, we're not at the point where press releases can be written by AI, at least not financial press releases, no way.
I hate to ask it because real people's jobs are now on the line, I'm sure, David. And I want to ask, is the CFO's role safe? Is this going to have repercussions from across your membership and employee base?
The CFO's role is 100% safe. 100% safe. Look, she and the team are taking this incredibly seriously, and you have to understand, I mean, we go through hours and hours of checking and double checking before something like this goes. It's an unacceptable error. Again, ultimately, it's on me. I'm the CEO. Buck stops with me. But the team is taking it super seriously.
And I know that you want to be talking ultimately about how you're seeing growth in the business, and I'm sure that that's something that, in a way, the salt in the wound is even greater because you had a great story to tell and it got marred by this particular error. But people are going back and saying they have never seen anything like this in history, David. What would you do differently in the next earnings? How can you make sure that investors feel confident in the statements that you put out to them in the foreseeable future?
Yeah,
I mean, look, I would look at our record and look at the growth, look at the fundamentals of the financials. And to be very clear, it was a bad error, but it was 1-0 in a press release. And, you know, a lot of other pages. And of course, we corrected it within seconds of finding it. So I think, you know, like with any mistake, I think it's not so much about the mistake itself. It's also about how you correct for it. And we've corrected for it, obviously, in the moment, putting out new materials, but also doing a really deep process dive, including having our own internal audit team, a separate team, look and figure out how we can make sure we never make a mistake like this again.
Okay, if you're listening on Bloomberg Television and radio worldwide, we're joined by the CEO of Lyft, David Risher. And I go back to the current stock performance. You are still up 32% in the session.
Yeah.
And there are so many stories within that, but I zero in on the gross booking outlook. Strong.
Yeah.
What is the story there? For me, I'm trying to make sense of the gig economy more broadly on both the demand and supply side. But if you look at the consumer, you look at corporate spending, you guys are adding to this narrative that things are quite rosy out there.
Yeah.
And when does that stop? How long does it last?
Well, look, I don't know when it stops. That's a tricky thing to predict. But here's what I can tell you. We've had now 4 quarters of growth, increasing growth. And we had our biggest growth year last year of our company's history. And by the way, we're talking about billions of dollars. By the way, billions of dollars that end up going in drivers' pockets. So you can see this is a really important part of the economy because it's a really important part of people's lives. When people take the 700 million trips they took last year on Lyft, they're going to see their parents, they're going to a Taylor Swift concert, they're going to work every day, they're coming home from work, they're going to see their doctor. This is an important part of people's lives. And then when drivers are driving, they're earning to save for a house, they're earning to save for tuition, they're earning because maybe they lost a W-2 job and they're 3 weeks away from picking up a new job and they need something to bridge them. So it doesn't surprise me that the gig economy is becoming increasingly essential part of people's lives and people's economic lives.
Your bigger competitor, Uber, succeeded by adding new products to the app, diversifying even within ride-hailing.
Yeah.
And it proved that its algorithm is working in matching riders with efficient routes and drivers. Do you feel that you're going to be competitive in those domains?
I do. Look, our focus is a huge strength. We are 100% focused on rideshare. You know, just yesterday we launched Women Plus Connect that allows a woman rider to pick a woman driver all across the United States, 270 markets. It's been a huge success over the first 6 months when we've been kind of trialing it. We launched a new driver standard that allows drivers to get a guarantee that they'll never earn less than 70% of what rider pays them after some fees. So, you know, this is the sort of innovation that we can do because we're focused on rideshare. And look, I expect Uber to do pretty well. I think we'll do pretty well too. I think this is a really strong sector.
I'm going to go back to the drivers, David, because what's interesting on this day is there is strike action. There is on Valentine's Day, whether you're going to be flying to Miami, whether you're going to be flying to Chicago, there might well be issues trying to get an Uber or indeed a Lyft, and also in the UK as well. I'm interested as to what's happening when you are offering 70% guarantee. Why still do they want to demand more, even if you say, look, I'm giving you flexibility?
Yeah, I mean, first, on the strike itself, Carolyn, it's been in the works for weeks. You know, so it predates the announcement of this new 70% guarantee. If you look at what the drivers are asking for, and I think these are reasonable things to bring up, they want more transparency on their pay. We've given it to them. We give them a very, very clear weekly breakdown that says this is how much riders paid you, this is how much we took, this is how much you get. They've asked for a guarantee, right, so that they don't, you know, so that there's a floor to their earnings. We've given them that too. They've asked for better visibility into deactivations. You know, if you as a rider raise a complaint about a driver, we have a whole process we go through. And drivers, of course, don't want to be off the platform, particularly if they think it was an unfair accusation. And now we cover something like 70% of those in less than 24 hours, and there's a new one-click button that allows drivers to sort of appeal the deactivation. So what we're doing is we're focused on drivers because we're obsessed over customers. That's kind of our thing. And by doing that, we think we can address a lot of their issues that they're raising.
JP Morgan actually completely in line with some of the words that you use there. The customer obsession is something they point out. The marketplace health is something they see to continuing to improve on supply tailwinds. So really drivers are not your issue at the moment compared to JP Morgan. Another analyst over at Nathanson, though, saying ultimately you're at the mercy of Uber when it comes to pricing power and take rates. Do you feel that way, that you're at the mercy of Uber in some way?
No. I mean, it's a competitive marketplace. So I think, you know, to a certain extent they're at our mercy like we're at theirs, right? We can't do things that are completely different and expect to have kind of reasonable results. But at the same time, for example, let's again look at this driver earnings guarantee. That's a commitment we've made. It's a leadership move we've made. We'll see whether Uber follows or not, but that's an area where I would say they're going to want to look pretty closely at what we're doing and decide whether they want to follow us. But I think, to be honest, I think this is a healthy marketplace. It's got two good players in it, Uber and Lyft, and we're both doing a good job. I like our strategy better because I think we're more focused on riders and drivers, and I think that's a real strength. But, they're doing a diversification thing. We'll see if that works for them.
For our Bloomberg television and radio audience, we're speaking with Lyft CEO David Risher. And David, as you know, we always go to our audience and ask, what would you want to know from David Risher? And it's the same question every time. Is Lyft an acquisition target? And many people put forward hypotheses about the type of business, maybe an automaker, maybe another convenience app. Mm-hmm. But where's your head at with that? You called your earnings performance butt kicking.
Yeah.
But there are still free cash flow questions. There are still scale questions with Lyft.
Yeah, well, let me talk about those and then get to the core of the question. Look, we were free cash flow positive for the second time in our company's history this quarter, and we've committed to investors we'll be free cash flow positive for the year of 2024. So, and we have $1.7 billion in the bank. So from a cash perspective, we're in pretty good shape. From a demand perspective, we're in good shape. Highest demand ever. From a supply perspective, we're in good shape. Highest driver's hours we've had since 2019. So, from a basic core, and then again, you think about it, 700 million rides in a year. I mean, think about a Delta Airlines that might do a couple thousand, maybe 3,000 or 4,000 takeoff and landings a day, whereas we do, let's say, 2 million a day. So our scale isn't really an issue for us. We've got pretty good scale. As to the acquisition thing, just like people ask the same question, I always give the same answer. It's like, our phone, we'll pick up the phone if someone calls because that's the deal, but it's not our focus. Our focus is customers.
All right, Lyft CEO David Risher on set here in San Francisco. Thank you so much for your time.
For sure. Thanks. I enjoyed it.
Caroline.
Such a deep conversation. Coming up, we continue the earnings conversation and break down those results from Airbnb, from Instacart. And of course, we've got to go back to watching not only what these two companies are doing, and they are under pressure in terms of their share price, up by 4.5% on Airbnb, more than 8% on Instacart. What's happening with Uber? Because they're unveiling a $7 billion buyback plan. Earlier, we heard from Pierre Ferragu of New Street Research about this money to investors. Take a listen.
If you are a cash machine and, the street is still relatively cautious in the way it values your business, one of the best use of your cash you can do is to buy back your own stock, because with low multiples, buying back is actually very, very efficient. So, that's music to our ears.
So thousands of US ride-hailing workers, they're striking at major US airports today, also in the UK, in fact. What are they demanding? Better pay, benefits, and in what organizers say is their largest strike yet. However, Uber has actually said, look, it won't have much impact on Valentine's Day operations. Joining us now to dig into the movement of Uber and Lyft, and more notably, what's happening in the rest of the earnings space. Bloomberg's Natalie Lung is here, Mandeep Singh of Bloomberg Intelligence. Natalie, I start with you. This sort of pressure coming from ultimately the supply side and the worry about regulatory changes, is it something that companies and investors should be worried about still?
It's definitely an overhang that analysts have been talking about. There's different laws that are coming up this year, such as the Supreme Court decision in California over Prop 22, which would guarantee minimum pay for drivers. In Minnesota, people are fighting for better pay standards. And so it's definitely something that would add cost for the company. But so far, whenever regulatory changes have been made, we see the company trying to pass that cost either maybe from the driver's side or passing that cost to customers by adding a fee. Like in New York, they added a courier fee after a minimum wage was implemented. So in a way, the business has a way to sort of mitigate these.
Mandy, this has been a pretty astonishing week in the world of gig economy, in the world of convenience apps, call it what you will. I guess let's go back in and zero on the Uber investor sweetener. It's an interesting one, but it's built on the back of a profitable year. And if you take that in aggregate with what David Risher of Lyft just told us, the demand side of this economy, it's holding up.
Yeah, I mean, look, I've always felt these companies generate, more value than the profitability that they have shown so far. And in this case, I think Uber has shown that it is working towards this vision of, becoming a super app where if you are thinking about transportation, you go to Uber, whether it's ride-sharing delivery or even taxis. I mean, we have come a full circle, in terms of disrupting taxis to having taxis on Uber's platform. And I think scale and operating efficiency is what drives a moat in this business. And I think Uber is clearly demonstrating that.
Okay, let's talk about Airbnb. The company gives a forecast on sales for the current quarter that even at the low end, Mandeep, is pretty good. And then, Natalie, and then tells investors, actually things aren't going to be that good, and then tells investors, we're going to be a different company in the future that does other things with third parties and AI. Summarize that story for us.
Right. A lot of this is what Brian Chesky has talked about being at an inflection point of the company. The post-pandemic travel trends, the post-pandemic boom has sort of faded, and that's kind of shown up in the financial performance. Growth isn't as strong as coming out of Omicron last year. And at the same time, they've sort of cleaned up their apps and services a bit, kind of encouraging more hosts to bring down some of the cleaning fees and encouraging more people to host, getting more users on the platform to make it more reliable. So he feels they are at an inflection point to be able to expand beyond that core hosting service, going back to before the pandemic, more ambitious endeavors.
Okay, Bloomberg's Natalie Lung and Mandeep Singh of Bloomberg Intelligence. Great analysis of a big week in the gig economy. Now, coming up here on the program, we're going to get into Akamai's fourth quarter numbers with their CEO, Tom Layton. Caroline, more stocks to watch.
Yeah, Instacart under pressure, as we were just looking at a moment ago. Now, this is as it falls on its fourth quarter revenue miss. They're also cutting jobs at the company. Restructuring heading pretty much at a pivotal moment for this particular company. We've seen the share price under pressure. As you can see over intraday, it's almost down some 10%. Mark Kelly over at Stifel, for example, saying it's a mixed fourth quarter results, a miss on the top line, but better gross transaction value and EBITDA. But this is a company that's once again having to belt tighten as they cut costs, and that means people. From New York, from San Francisco, this is Bloomberg Technology. let's just take a look at Akamai shares at the moment. Under pressure. This is after the company, the infrastructure software company, reported fourth quarter results. And look, it was relatively mixed is what the street is interpreting. Maybe a little bit cooler than expected in adjusted earnings per share, though they did indeed beat some expectations. We're going to walk through the numbers. CEO Tom Layton is with us, I'm pleased to say. And just getting back to the mixed results. Weakness in core content delivery network, that part of the business. What drove that weakness? Is there going to be some recovery, Tom?
Yeah, we're the largest content delivery provider by far, and very important business for us. But today, most of our revenue is now security, performing very well, growing in the mid-teens, and compute, which is a really exciting area for us. Did very well, reached $500 million last year with strong growth forecasted for this year. So delivery, important, great business, market leader by far. Pricing pressure there. It's a business we've been in, really created 25 years ago. So there is some pricing pressure there. But the exciting, I think, things about Akamai would be the security business and the compute business, which is now approaching about 2/3 of our revenue.
So the compute business is posting pretty solid top-line growth, but what are we talking about there, Tom, the market for compute? Who are the customers you're serving, and what is it that you offer?
Yeah, the compute marketplace is enormous. Today it's well north of $100 billion and growing rapidly. And what Akamai is doing is bringing compute support for VMs, for containers, for Kubernetes to the edge, and really the edge. Our goal is by the end of this year to be supporting compute, full stack compute in 100 cities around the world, which nobody else does today. And that will give us better performance, better scalability, and also because we can take advantage of our existing delivery platform, which is in 4,000 locations, better economics so that our customers can get better performing compute for their applications at a lower price point.
Ed?
Structurally, Tom, when you look at your business, where are you growing the most internally? We've talked about this idea that companies have had to reduce costs and then reallocate either talent or simply dollars because there are different speeds happening within their business lines. That's exactly what's happening with you, and I wondered how you've responded to that.
Yeah, so we have shifted a lot of the resources and investment from the delivery side of the house into compute and also security. And so you see that reflected our numbers with a very strong growth in security and compute, very good profitability. And we've been able to do that investment because we have shifted a lot of resources from the delivery side. Also, we're now big users of our own compute platform for our own applications, and that is saving us a lot of money, which we then plow back into development of new capabilities to drive future growth.
It's interesting that some analysts note that the bears are going to fixate on inline fourth quarter revenues, shaping up a surprise, as you mentioned, with the compute beat, but ultimately the offset in the delivery. And they seem to say there's this elusiveness of delivery stability. Can you guide us as to when and where we will start to see ultimately stability? You talk about the pricing pressure, but what about the traffic load, Tom?
Traffic growth is a little bit higher this year than it was last year, but still below historical pre-pandemic norms. And of course, there's continued price pressure, and we're being more selective in the deals that we take. So we have been, not taking on some of the, the contracts and opportunities there where it's less profitable. Others, can do that. That helps our profitability and helps us move more investment into security and compute. And so that's driving a little of what you see with, the revenue on the delivery side declining in the single digits. And really, our focus is on where we're doing security, which is a bigger product line growing in the mid-teens, and compute, which has enormous potential growing at over 20%. So you'll see us continue to do that. And I think the focus really shouldn't be on delivery. And in fact, as a result of the continued shift into security and compute for our revenue, this year our guidance is there'll be accelerated overall top-line growth for Akamai and continued strong bottom-line growth.
We'll see when the share price starts to factor that in a little bit more on the day. But for now, we thank you so much, Tom Layton, as always, for joining us, the CEO of Akamai. Meanwhile, coming up, we've got a deep dive with, well, a key player in the tech space. You'll know him, Brett Taylor, from, of course, his history at Salesforce, of course, at Meta. And indeed, Clay Bavor is going to be joining him as well as they officially launch their new product, Sierra. This is Bloomberg Technology.